Every year, millions of investors do nothing and beat the majority who try. No screens, no stock tips, no hero trades, just a quiet purchase of a fund that buys everything and takes a nap. It sounds like negligence. It's actually a revolution. A rebellion against fees, hype, and the illusion of control. The paradox is simple and infuriating. The lazier you are, the better you tend to do. This is the place where money, power, and history collide, and nothing is as simple as it looks. Indexing isn't merely an investing trick. It is a political act against a system designed to charge you for activity you don't need. The unsettling truth is that markets didn't beat stock pickers. Costs did, frictions did, human error did, and a quiet idea turned into a tidal wave. To understand how a strategy built on doing less conquered a culture addicted to doing more, we have to go back to a man with an unfashionable idea and a calculator. In the 1970s, Wall Street treated stock picking like priesthood. There were research terminals and whispered calls and conference rooms with the glass frosted just so. Into this cathedral walked John Bogle with a heresy. Most managers won to beat the market after fees and taxes. So why not buy the whole market, charge almost nothing, and let compounding do the work? The industry laughed. They called the first retail index fund Bogle's Folly. The sales pitch was almost rude. We won't try. But he wasn't selling genius. He was selling arithmetic. If all investors together are the market, the average investor must earn the market return before costs, and less than the market after costs. Subtract fees, subtract taxes from frantic trading, subtract mistakes, and what remains is what most people should have started with, the market itself. Indexing works because of gravity, not the gravity of price discovery, the gravity of cost. A 1% annual fee sounds small, like a rounding error. Over decades, it's a slow amputation. Compounding doesn't care about your story, it cares about your net rate. Shave 1% for 30 years, and you'd be cut a third or more of your ending wealth. That is why passive is just a polite way of saying, I decline to pay tolls on every mile. Then there is the behavior tax. Humans chase heat and flee cold. Buy high, sell low, repeat until broke. An index fund removes choice at the moment you are least equipped to make it. That's not weakness, that's design. Guardrails for the primate with a brokerage app. Finally, the market's micro-truth. In any given year, a few stocks do almost all the work. Miss the handful of big winners and your performance sinks. The index never misses them. It owns them before anyone knows which ones they'll be. So is an index fund smart? Not really, it's honest. It admits the future is unknowable and refuses to pay profits. It says, I do not know who will win. I will own whoever does. What is an index, practically? It's a rule book. Own everything in this list. At these weights, rebalance this often. The S&P 500 is big U.S. companies weighted by market value. A total market fund owns almost everything listed. Global XU. S owns the rest of the planet's public equities. The fund's job is clerical. Track the list cheaply. Market cap weighting is both elegant and infuriating. Elegant because it requires the least trading. Weights float with prices. Infuriating because it makes you own more of what just got expensive. But remember, the alternative requires knowing what's mispriced now, cheaply, tax efficiently, and repeatedly. Good luck. The index's humility beats your hunches because humility is cheaper to run. There is no free lunch, but indexing comes close, at least on pricing. Defenders of stock picking say indexing is parasitic. It benefits from prices set by active managers. They're not wrong. Price discovery, the act of pushing a stock up or down toward fair, is messy, costly work. Passive investors get the price for free. The bill shows up elsewhere, in governance. As trillions migrated into passive funds, voting power concentrated in the hands of a few firms. The Big Three hold significant stakes in thousands of companies and can sway votes on executive pay, mergers, and climate disclosures. You didn't hire a lobbyist, but your index fund accidentally became one. Lazy money can be powerful money. Quietly, an index fund doesn't ring a bell. It slides a proxy card across the table and nudges the future. Indexing's rise didn't just happen in mutual funds. The ETF put a turbocharger on the idea. The old index was something you bought once a month and ignored. The new index is something you can trade 20 times before lunch. Same rules, different tempo. That shift created second-order effects. Intraday liquidity means you can exit the market in seconds. That's a feature and a temptation. The behavior tax sneaks back in with a different hat. Rebalanced schedules create predictable flows. When indices add or drop companies on a known date, arbitrageurs try to front-run the trades. It's a cost to indexers, mostly small but not zero. And the market started slicing itself thin. Index no longer means broad. Today, there are indices for AI plus dividends with low carbon in mid-cap Europe. That's not passive. That's marketing with a rule set. Indexing superpower is breadth, simplicity, and low cost. The thinner you slice, the more you drift back toward active with a passive costume. The lazy revolution has a concentration hazard. In cap-weighted land, winners get heavier. In certain eras, a handful of megacaps carry the whole index. That creates three realities. First, your diversified portfolio isn't as diversified as it looks. If the top 10 names make up a huge chunk of your index, your fate is chained to their earnings calls. Second, bubbles feel rational while they inflate. Cap weighting forces you to buy more of what's rising because it's rising. You own the euphoria by design. There is no take profits button on an index. Third, does price discovery shrink if passive becomes too large? Maybe, but it takes remarkably little active capital to set prices at the margin. The paradox persists. A few sharp speculators can keep the game honest while the rest accept average. And average in markets is elite. The long-term market return is what most active managers dream of and rarely deliver consistently after costs. Myths cling to indexing like barnacles to a hull. The first myth says indexers are freeloaders. Good. Raise your hand to price the securities for us. We'll keep the savings. The second says indexing kills capitalism. No. Index funds don't prevent competition. They simply refuse to bet on outcomes. Companies still fight for profits because executives, employees, and customers don't live in index land. The third says indexing guarantees safety. Absolutely not. The market is volatility. Index funds promise exposure, not protection. They are surfboards, not seawalls. The fourth says you can beat the market with discipline, sometimes. The question isn't can anyone? It's can you for decades net of costs and taxes without turning your life into a trading desk? Most people have jobs. Indexing lets them keep them. Wall Street sells complexity because complexity is billable. Indexing sells humility because humility is cheap. The quiet arithmetic of freedom is embarrassingly simple. You can't control returns. You can control costs. That's not a slogan. It's the only guarantee in investing. Cap-weighted broad funds trade less, distribute fewer taxable gains, and ask less from your accountant and your blood pressure. Automate contributions into a broad index over time, diversify across geographies and asset classes, rebalance by rule, and then go live your life. The revolution isn't that index funds made people rich overnight. It's that they made ordinary wealth accumulation possible without a second career in markets. But lazy can become dangerous. There are failure modes. Overconfidence in autopilot is one. Owning a broad index doesn't mean your job is done. Asset allocation still matters. A 25-year-old and a 65-year-old do not need the same glide path. Home bias is another. People buy their country's index and ignore the rest of the world. That's not patriotism. That's concentration risk wrapped in a flag. Chasing the shiny passive is a third. Low volatility dividend momentum ESGAI is not lazy. It's sophisticated vending. If you can't explain the index in one sentence, you're paying for opinions you didn't intend to buy. And liquidity panics matter. In a crisis, ETFs can trade at discounts or premiums to their underlying assets for brief periods. If you're clicking frantically, you've just turned passive into active at the worst possible time. Lazy should describe the day-to-day, not the design. There's also the quiet politics of indexing. Indexing democratized ownership. A school teacher buying a total market fund becomes a partial owner of factories, software platforms, railroads, and drug patents. That's not rhetoric. That's a transfer of power, tiny in each account, massive in aggregate. And it terrifies industries built on skimming. But power moved in another direction too, to the stewards of those funds. When three firms can swing a vote across thousands of boards, the question becomes, who governs the governors? Index funds didn't seek that role. They acquired it as a side effect of winning on cost. The lazy revolution needs a constitution, clear stewardship policies, transparent voting, client-directed options, so the quiet doesn't become complacent. The right to be lazy with your allocations should not require you to be lazy about how your vote is used. Let's talk practically, because a revolution that can't buy groceries isn't much of a revolution. What should you actually own? No recommendations, just a framework. Broad and boring wins. A total U.S. market fund plus a total international fund covers the planet. Add a broad bond index for ballast if your horizon is shorter or your sleep is fragile. Keep your all-in fees under control. If your blended expense ratio starts with a 0 and a point, you're in the right neighborhood. If it's sneaking toward 1%, ask yourself who's getting rich. Automate contributions. Same amount, regular cadence, regardless of headlines. Your calendar beats your emotions. Rebalance by rule once or twice a year. Nudge back to target weights. No hunches, no feels toppy monologues. And ignore the circus. If a stock split trends on social media, that is not a plan. That is a costume party. The cultural reframe matters. Wall Street glorifies action. Finance cinema worships the trader who sees the trade. Indexing celebrates boredom. That's not romantic, but it's profoundly subversive. It says, my time is precious, my ego is expensive, and my future does not depend on guessing next quarter's margins on a chip designer. The lazy revolution is really a dignity revolution. Keep your hobbies, keep your evenings, keep your money. There's also an invisible payout indexing delivers that never shows up on a statement: the stress dividend. The payoff from not checking quotes, not waking at 3 a.m. to a red candlestick, not explaining to your family why this time the trade will work. Simplicity compounds like capital. Every hour you don't spend arguing with your portfolio is an hour invested in your career, your health, or your kid's science project. Boredom is alpha, paid in peace. Edges exist, of course they do. But real persistent edge is scarce, expensive, and usually consumed by the search for it. Indexing's edge is the only one most people can actually keep: discipline. If you hold broad assets at low cost across time, you harvest the world's productivity without trying to predict the weather on a single street. Markets will crash, headlines will scream. A guru will call the top, then the bottom, then sell a course. The lazy revolution shrugs. It keeps buying the human project. It accepts drawdowns as rent. It lets the economy's long, messy upward crawl do the heavy lifting while you go live a life. Now, some nuance for the connoisseurs. Cap weighting isn't the only way to build an index. There are equal weighted indices, fundamental weighted, minimum volatility, and dozens more. Some are thoughtful, some are gimmicks. But the more rules you add, however sensible, the more you drift from the core promise. Own the whole, own it cheaply, trade rarely, keep taxes low, and don't try to outsmart the market's constant surprises. The market doesn't need your brilliance. It needs your patience. And about that concentration risk, there are ways to manage it without abandoning the revolution. Equal weighting spreads exposure, but it trades more, which raises costs and taxes. Tilting towards small caps adds diversification, but it can add volatility and tracking error, the psychological cost of looking wrong for long stretches. International diversification helps, but it comes with currency and governance differences. None of this is an argument against indexing. It's a reminder that every design has trade-offs. Even the lazy must choose their flavor of laziness. Another lingering concern is the tragedy of the common story. If passive keeps growing, who will set prices? The answer so far is the marginal trader sets prices, not the median. It doesn't take a majority of active dollars to move a price. It takes the last buyer and seller willing to disagree. As long as there are incentives to be right, there will be enough wolves to keep the sheep priced fairly. And if there are moments when passive flows overwhelm prices, rebalances, inclusions, exclusions, those are tiny rents the market charges for a lifetime lease on sanity. There's a deeper philosophical point, too. Indexing rejects the hero narrative. It says, you do not need to be chosen. You do not need to be special. You can be average and still build something extraordinary, because average, when compounded, is astonishing. We instinctively resist that because we want to be the outlier. We want the story about the early retirement on one speculative coin, the 10-bagger, the perfectly timed exit. But the market Wisdom-S best kept secret is that the average is already a miracle if you stop setting it on fire. The lazy revolution is also a truce with time. We are finite. There are only so many decisions you can make in a day before the quality collapses. Indexing saves your decision power for choices that matter: your work, your relationships, your health. Busy portfolios ruin quiet lives. Quiet portfolios fund busy lives. Choose accordingly. And then there's the fragile moment when the revolution meets reality, the first big drawdown. This is where stories die. The screen blares red. The pundits dust off the word unprecedented. Your neighbor starts sending articles about safe havens and hard assets and end times. The lazy revolution doesn't deny fear. It budgets for it. It says, this pain is rent. It says, we knew there would be storms when we chose a surfboard instead of a seawall. It says, rebalance if you must, and only by rule. Add a bond index if the seas make you seasick. But do not turn your philosophy into a mood ring. There's a quiet heroism in doing nothing when doing something feels virtuous. It is the kind of heroism no one writes about because it doesn't make a good montage. No ringing bells, no standing ovations. Just another automatic contribution sliding into a broad index, buying a sliver of the world you'll never see. A factory in a city you'll never visit. A software platform you'll never log into. A railroad line you'll never ride. Ownership without obsession. That's the promise. Some people hear all this and say, so you're telling me to be average? No, I'm telling you to be finished. I'm telling you to design a system that works when you don't. I'm telling you that your edge is not clairvoyance, it's consistency. I am telling you that the market's greatest gift is that it doesn't need your opinion to pay you. There's one more reason the lazy revolution won. It's honest about luck. Active management, at its worst, confuses luck with skill and charges you for the confusion. Indexing says, luck is part of the world. We'll own the world and let luck show up wherever it wants. Some years, it will look like you owned the right things. Some years, it will look like you owned the wrong things. Both observations are true and useless. The only question that matters is whether you stayed in your seat long enough for arithmetic to overpower mood. A final caution. Don't make index funds into a religion. They are tools. Tools can be misused. You can overconcentrate. You can undersave. You can buy expensive versions of cheap ideas. You can trade your ETF like a slot machine. You can forget that bonds exist until your nerves do not. The lazy revolution frees you from the theater of prediction. It does not free you from responsibility. You still have to decide how much to save, how much risk to carry, and how to behave when the world tilts. Still, when you zoom out, the case is embarrassingly clear. Politicians promise prosperity. Managers promise alpha. Brokers promise access. Indexing promises none of that. It offers something rarer, a system that works when you don't. That's why the lazy revolution won, not because it's clever, but because it's honest, because it respects arithmetic more than charisma, because it knows that compounding is a quiet god, and that the loudest rooms usually have the worst math. You may meet people who sneer at the word passive, as if it means weak. Smile. Passive is not a personality trait. It's a cost structure. It's a steering wheel set straight on a long road. It's the courage to be average in a world obsessed with being special. And when experts talk about beating the market, they're selling an illusion. The goal isn't to defeat the market. It's to own it, cheaply, patiently, and without drama, so it can fund the boring miracles of ordinary life. A home, an education, a decade you're not forced to sell. The modern financial system turned activity into revenue. Indexing turned inactivity into wealth. The line between skill and luck, between prophecy and patience, has never been blurrier. Lazy once meant indolence. Today, it means design. Do less, own more, pay little, wait longer. Boredom is alpha. Peace is a dividend. And the market, indifferent to our ego, keeps breathing in and out while the rest of life happens. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.